Good morning, Don.
Good morning, Pete. My name is Don Vivrette, and this is Financial and Estate Literacy. It's your estate. We're doing charitable opportunities. Pete, would you like to talk about the fact that financial estate literacy is a 501c3?
Yes, financial and estate literacy is a 501c3, which essentially means that we're a not-for-profit and registered in the state of California as a charitable organization. And we started this, by the way, Don here is a board member on our group, and also the philanthropic advisor. And we'll introduce him in just a second. But we started this because there's very few places where you can go and not get sold something while you're trying to learn about financial, estate, or even charitable matters. I've worked for a variety of different organizations: Father Flanagan's Boys Home, Long Beach State University, the American Heart Association. And when we put on programs talking about charitable techniques, it was always felt like we were selling a product. And, you know, when it comes to money, it's hard to learn if somebody's trying to sell. So one day, Don and I were traveling to see a friend of ours, and we started talking about the sale of his business. And I just happened to pop in and said, well, have you run the numbers? And Don is a CPA. And he said, what do you mean run the numbers? And so I said, have you run the numbers to see whether or not, if you include a charitable trust in your plans, what do the numbers look like to you, so you can decide as to what you wanted to do? And he said, no, I haven't. But what you said, it sounds interesting. And the way Don is, he took that ball and ran with it. He not only ran the numbers, he bought the software, he took the course, and he did the charitable trust. And, you know, and that's kind of where we are with you. Anything that you're going to learn today, spread the word. Very few professionals know what a charitable gift annuity is, because nobody can make a commission on it. Very few attorneys or CPAs are involved with a charitable remainder trust and how it fits into an estate. So what you're going to learn today is probably more than most professionals are going to know. Don, would you like to add anything else onto that?
No, why don't I? Whoops, wrong way. I didn't want to go there. I want to go here. So what I'm going to do is bring my screen back up, and I should be there with no sound in the background. Although I seem to have a gardener next door who's decided he wants to do the yard.
Yeah, I can't hear anything, just so you know.
Thank you. I'm glad occasionally people go, there's someone in the back of you. Okay,
yeah,
so
yeah.
Anyway, so as Pete said, I'm serving as the philanthropic advisor for financial and estate literacy, and I'm on the board. And so that's sort of the background. But one of the things that I wanted to point out when we first started this off is this is Charitable Opportunities, and it's really, as Pete said, the accountants and the lawyers rarely know much about this thing. And so I figured it was probably good to go through and talk about it, because when you give to charity, you're going to be better off. But on the other hand, you can also, you're better off mentally, but you're also financially probably going to be better off. And that's very important, because most people think, well, I'm going to give it away and it's lost. And that really isn't necessarily the situation. I'm going to put my glasses on because the screen is telling me something that I can't read. Okay, never mind. I didn't need that. So let's talk about ask first form.
Yeah,
so as we do with people.
Yep, you're a certified accountant.
I'm a certified
accountant. Crazy.
Yes.
For 30 years, and you have been a consultant for those 30 years. and advising other people as to what to do and not to do. And as a philanthropic advisor, how do you charge for your fees?
That's down farther on the page. Let's stay up here. One of the things that Pete's always interested in about is the credential versus a license.
Oh,
and
okay.
I just want to point out from a CPA standpoint, and really both, you become a certified public accountant. That's the exam and you pass that. Then you have to be licensed, and that's renewable every year. So in a sense, I have wind up with both of those two. I don't practice law, as this says. And for the second half of the page, since I blew all these things up, my relationship is fiduciary. I only work for clients and work with them and help them figure out what they might want to do and what's going on. And I'm in, because of Pete's advice in terms of what to do with the building, it wasn't actually the company, it was the building that we sold. I don't need the money. I don't do this for the money. I do this because I think it's very good. So on the other hand, if we do help you and it takes a while to do it, I'll run the numbers for free. I'll just do that because it's interesting to see what people do and where they may want to go. If we really get into a lot of time, I'm going to charge you $125 an hour, which isn't much. But what I'm going to make you do is write a check to a charity. I don't want the money, but I want you to pay something, because most people say, well, if it's free, it isn't worth it. Okay, then I'll charge you something, but you get the tax deduction for doing that because you're going to write it to a charity. And financial and estate literacy is a 501c3. So
Yeah,
you can
we're not
write a
trying to
check.
push that.
No, I'm not at all.
Yeah,
No,
you
no.
can pick out any charity that you want, and it's really true. Even the workshop series, when I mentioned to other people that we don't charge for the workshop series, and many individuals go, okay, well, why are you doing it? What are you getting out of it? Are you selling your services? Or and we go, no, we don't sell our services. We don't. This is purely education. Very few people believe us.
And we're somewhat the anomaly anyway, because normally the presenters are financial planners or estate planners, and they do charge their fees. And Pete and I are sort of the oddities in this thing in so many ways. But one of them is we do it because we like this and we think it's important, and that's what we do.
Yeah.
So let's get into it.
And the other thing too is that with the Ask First form, you are in control. You can contact the person, the presenter. The presenter is not going to contact you. So nobody's going to try to sell you anything. And this is a fun session. So I thank you for being here for this. It's actually enjoyable.
That's why we changed the visual when you first came in, because we thought it'd be more exciting in this one than some of the other ones we have.
Okay, let's get started.
Okay, what are the issues we're trying to resolve? You may have a big house somewhere and you want to cash it out and figure out what you're going to do with capital gains. And that's a real interesting problem. As Pete has said, that's basically what we faced with an office building. And so how are you going to deal with that and get out of it? From an estate planning standpoint, the other part of this is, how do you help your creative kid, we will be nice and say, from spending all the money that they inherit, especially if it's an IRA account, and yet you want to still be fair to all of your kids as appropriate. You also may want to give to a charity in some form, simply because that's a good thing to do also. It's not saying you need to or something else, because actually by giving, you may well get more than you think back from that. And that may be just good for you, but it may also help others in terms of getting a tax deduction and helping other people during your lifetime in terms of what you're doing.
I've worked with individuals that felt guilty about getting an income tax deduction. They said, I'm doing this because I really believe in this cause and it's a gift. And they think that it's lessened the gift, a part of it, when they receive some of the benefits of giving. What we hope is that if you are going to give, you do it in a tax-wise manner. And that's kind of one of the things that we're talking about. The other thing too is that when you mention property, and think of all the 1031 exchanges that are being done today. Using a charitable trust never comes up in the conversation ever on those 1031 exchange.
And just in case you haven't dealt with what a 1031 exchange can be used, if you're trading a piece of property for another piece of property, then you defer the gain or other things into the future. And that's what happened with us with the building, because we'd had another building, we sold it, we moved it to this building, we moved it to that. And then all of a sudden you're hit with, oh my God, the gain's all the way back to the first building. That's what a 1031 does. However, you have to figure out how to get out of all that loop. Charitable giving is a good way to do it.
Yeah.
And incidentally, if it really truly bothers you to take a tax deduction,
You don't have to.
don't take it.
Yeah.
They don't force you to take a tax deduction. It's available to you and you don't have
We
to.
encourage it because you may be able to give a little bit more, you know?
Right.
And giving makes you feel good.
That's a good line, Pete. I like that line.
Yeah, it's empirical. I mean, they've done numerous studies. People who give live longer, are happier. And I guess I'm not sure exactly the reason why, but they call it eustress. Like stress wears you down. Eustress is what happens with you when you are good to your family and good to others.
Yeah. So that's the first part of this thing. You can do it because of generating income also for either you or for your beneficiaries or for both of you. A lot of people say, oh my God, my children will kill me if I give stuff away to charity. Well, you don't have to give it away. You can also benefit them. And my argument is, well, you're also dead at that point. So they really can't yell too loudly at you because you died. It also can result in a tax savings. So we'll walk through those.
Yeah.
Speaking of which, one of the issues that comes up is when is a deduction and what type is a deduction, just to fill the loop on that one. If you give to charity today, we're going to make the assumption you're alive because you're listening to us. If you give to charity today and you get nothing in return, so I just write a check to somebody, to a charity, and I give them that check or whatever it happens to be, you get an income tax deduction for the full amount of that gift that you've given. There is no reduction by anything if you get nothing, maybe a thank you letter, but if you don't get tickets to the Laker game or if you don't get other kinds of things,
it's a nominal gift, a
nominal gifts, which is not a Laker ticket today. But it's or something else. But if you just give it to them without expecting anything else, you get a deduction. And it's if you itemize your expenses on your taxes, that's a deduction then against your adjusted gross income. We refer to AGI a lot. Typically, if you gave cash, you can take up to 60% against your AGI. If you give an appreciated asset, your house, stock, whatever else, then you can deduct 30%. But it's this year and 5 additional years in the future. And I'll go through that more in a little while. So normally you would then need to itemize your taxes. Now, if this is a large enough gift you want to, the other is, we'll talk about QCD in a few minutes, a bit why that is, you don't need to itemize to use that one. If you give to charity, like a charitable gift annuity or a charitable remainder trust, you're going to get something back. You don't get to deduct the entire item that you put in. You get to have the net present value. What you're going to earn in the future is deducted because that's a benefit you're going to get. So there's a difference and there's calculations you do. As Pete likes to always say, run the numbers and see what it says.
The numbers. And by the way, what Don will show you in just a little bit is what's called a gift illustration, which will lay out all these numbers for you.
Right.
And unless you run the numbers, you just don't know exactly what's best for you.
Right. And I'll show you a real example of that when we're going through the charitable gift annuity of using different rates. I'm sorry, a charitable remainder trust and showing how that changes as you go through. So that's the net amount. I had a friend that was very upset because he was giving money to the University of California and he was ticked off because he didn't get 100% deduction. I said, it's a gift annuity. You get income for life. I know, but that's in the future. Oh, okay. Sorry. Anyway, was a lawyer in the past. If you wait until you die, and this is something that is part of your estate, then the estate will get a tax deduction for it. Now, in today's world at $12,900,000 per person, you and your spouse, if you happen to be married, that may not be a big issue to you unless you have a much larger $25+ million estate, or if they reduce the amount in 2025. It becomes an estate tax deduction, but you don't get a current deduction because you think you're going to do something after you die. For some reason, the IRS doesn't appreciate that part. So that's the way you have to look at it from, is this an income tax deduction while I'm alive or an estate tax deduction? So where do we go from this? Talk about IRAs and IRDs. IRDs is in respect of decedent. What happens when you put money into an account, and we'll talk about it a little bit as we go through this, whether you're alive or you passed away, that same account is treated in respect of the decedent, of you, whether you're alive or dead, in a sense. When you put money into a 401k or an IRA or a 403b, whatever they happen to be, those generally go in without tax being deducted. Before your income tax, you put the money in. And so when you take it out, the IRS would like to share with you. And so they're going to tax the money as it comes out. That's the issue that you face, whether you're alive, I'm old enough to have to take an RMD, or whether you passed away and it goes to your heirs, whoever they are.
Somebody's going to pay the income tax.
Except for charity, which we'll talk about.
Yeah.
But somebody's going to pay the income tax in respect of decedent. IRD is what those are term is. And we spent a lot of time talking about that last week with retirement accounts, but I just wanted to emphasize it again here. If you are currently 73 years old or older, you have the opportunity, you don't have to, you have the opportunity that you must take of taking a required minimum distribution, RMD. That is something that has to be taken every year. And if you don't, there's a hellacious penalty against you if you don't take it. It's based on your age, 73, then 74 as you go up now. In the future, so if you aren't 73 yet, and by 2033, this will advance out to 75. It's based on the value of your account, December 31 of last year, and a factor based on your age. So in this particular case, I've used as an example an 80-year-old. If her account was based December 31 of 22, if it was based on, it had a value rather of $500,000, she's 80 years old. As an 80-year-old, you use a factor of 20.2, you divide that into 500,000, and her RMD would be $24,752. You need to take that out of one or more.
That amount, is that amount subject to ordinary income tax?
Just a moment, and I'll tell you the answer to that question. So one of the things I will tell you, incidentally, is these amounts change every year. I have done it here in 5-year increments, but they are, in fact, every year it changes slightly. So as you get older, they would like more of it because probably you aren't going to live a lot longer because they've subtracted out a year from you. If you're wondering, where the heck do I get this number? I will tell you that in January on my my statement from Schwab for my IRA account, here it is. And on the very last page, there's this one little section that says RMD for 2023 is X amount. So if you don't feel like doing the math, that's where I found mine one day after having hunted the entire way through it, thinking, why didn't you tell me? But as Pete just pointed out, this produces taxable income, ordinary income. It doesn't matter that you put money in for the last 5 or 10 years. It comes out as ordinary income, not capital gains. That's what the IRS would like back from you. So this money is going to, that in her case, would increase her ordinary income, $24,700 and some odd dollars, which is going to have an effect on her income tax, also perhaps on her Medicare cost, and incidentally, her Social Security may be taxed more because she's got into a higher bracket for Social Security tax. So one thing to consider, if you don't need that money to live on, and that's a very important thing, and if you wish to give money to charity, you can use a qualified charitable distribution, a QCD, they're big on initials. And this is out of an IRA account, not for a 401k or a 403b or something like that. It needs to come out of an IRA account. And for reasons I can't begin to guess politically, this was left at 70 and a half years old, which used to be the date for the RMD, but they didn't bother to take this one up at the same time. So literally it's 70 and a half. This is 100% deductible, and I'll show you how that works in a minute. You go and tell you whoever's the administrator of your account, I want you to write a check to Red Cross. I don't care who you want, any charity you want to do, in this amount of money, and they're going to write a check to Red Cross, And my suggestion is you have them mail you the check. You make a photocopy of that check to protect yourself. And you note the fact that this went, and you put a note into Red Cross and say, this is from me. This is why I'm giving it to you. If you have them mail the check directly to the Red Cross is going to get a check, and it may not have your name on it or anything else about it or why you're giving them the money. That's simply going to go into them. You can only, he says in quotes, deduct for a QCD is limited to $100,000 a year. So in my little example over here where she had 500,000, if she had something over $2 million in her IRA, she would only be able to take 100,000 because at 500 it was 25. 4 times that's 2 million. So that's what you want to do. It doesn't matter if you itemize or not, because this income never comes in. If you took a QCD, that amount of money is removed from your 1099-R. You would tell your accountant or whoever's doing your taxes or yourself, don't pay tax on this amount, and you can prove it to the IRS because you have a copy of the check. So you don't have, wait, no, I don't itemize. I use standard deduction. Doesn't matter. In this case, it reduces your income, which may reduce your taxes, will reduce your taxes,
About
may reduce
85
your Medicare, and may reduce how much you have to get taxed for your Social
Yeah.
Security.
And probably, but they say that the
Statistics.
yes, today is that 85% of us take the standard deduction.
Yeah.
So we don't use the income tax deduction
Right.
like we did prior for charitable gifts.
Right.
So it's a slam dunk. If you normally give to charity at the end of the year, just have it come out of your IRA.
So this is, and Pete had mentioned gift illustrations. So here's an illustration. There's a software company called Crescendo, who's sort of a standard in the industry in terms of charitable giving. You put in these things and it produces these little visuals and lots of other stuff that go with it. And you'll see them through this presentation. And that's what we want to talk about. So in this case, I'm using my friend from the previous slide. She had a $24,752 RMD, required minimum distribution. If, for example, she gave $15,000 to charity, that goes through, that counts towards her RMD. And so now she would only pay tax on $9,752. She's just saved $3,000. Incidentally, you can give to as many charities as you want, as much as you want, high and low. You can also say, but I want to give it to somebody during the year. Okay, tell them during the year, not a problem. I would suggest you do this at or around before the 1st of November, because that way you make sure it gets done and out of the way. But this is an extremely important one. And let me give you a different example, couple of examples. This is similar to the one you just saw. 25,000, if 10 of it went directly to charity, you're only taxed on 15, which means you just saved $2,000 by having that go directly to the charity. And the one that really gets people is, if you gave money to your church every week, for nice numbers, let's just say $50 a week, whatever it is, that's $2,600 you're paying in a year. You'd have to take out $3,250 to pay that 26, because when you take out the money, you have to pay $650 in taxes. And that's not going to go away. If you say no, write the check to the church directly, then you would only have to take out $2,600. You just saved $650, and you were doing something you wanted to do anyway. If you don't want it and you need the money to live on, don't worry about any of this. You have other tax deduction problems anyway, issues anyway. So this is if you want to give them, and it is absolutely 100% deductible, regardless of itemizing or standard deductions. It doesn't matter.
QCD.
QCD, yes.
Yeah, new abbreviation in our vocabulary.
Yes, yes. Okay, we talked about it a bit last week. I want to re-enter it again this week. IRA accounts going to your heirs. This is where we look at it from the estate standpoint here. Secure Act changed the rules, and with exceptions of spouses and some other people, if I have my IRA go to our daughter or daughters, they have to take out the money within 10 years. part or all of it has to be taken. You can take it each year, or you can take all of it now, or all of it at the end of the 10 years. The slight difference, and I changed this versus the visual that is on the website. If I currently, I'm 73 or over, so I take out my RMD. If my children get this account from me, they will have to pay an RMD based on their age during these 10 years. If I was only 70 today and hadn't started RMD, they wouldn't have to take it out during the 10 years. That's an odd little anomaly that comes in here, but it is a factor that needs to be considered by people. If you pass this to your child, depending on the child, they could say, oh, I'm going to take all the money out now and have a wonderful time. And that may not be what you wanted. You wanted them to spread it out over the 10 years. You wanted to have growth over the 10 years. And I'm going to change this from saying a kid to someone else. A woman I know a while back made a comment that her mother passed away and her father inherited the IRA, spousal pass over to him. He decided to cash out the account and go buy a Porsche because his wife wouldn't let him have a Porsche while she was alive. So he used her money to buy himself a Porsche. No problem. That's what he's allowed to do, except he forgot that it was taxable. So then out of his money, he had to pay the tax, the income tax that he received. So it isn't just kids, it's anybody that gets the money.
Yeah, and it's really common because they don't tell, this is the first money that's available to a beneficiary.
Yes.
And the person that they're working with, whether it's a Schwab, a Merrill Lynch, or Ameriprise, they don't know the tax consequences and they don't know your income tax bracket. And I would say 90% of individuals take the money outright, all of it, because this is the first money that's available to them upon your death. And all they have to do is wait 10 days to get the death certificate, go to wherever you had the IRA and say, hey, I'm the beneficiary named on this account, show them the driver's license, and that's it. They got the money. So stretching for a lifetime, yeah, it was there, but so few people took advantage of it.
Right.
And now it's 10 years, and I still think few people will take advantage of it. But if you want, and you got to check out your beneficiaries, sometimes you just can't handle a lump sum. And talk a little bit about that testamentary trust.
So one of the issues is when that money comes out, as we have said, for an individual, it's going to be fully taxable as ordinary income to you. If they take it out as a lump, they're going to pay that tax in one lump year, which is going to raise their tax brackets, and now they're going to pay even more money out. If it's given to charity, charities don't pay taxes. Therefore, it goes to them directly. And I'll show you an example of why that is important to you. What Pete was referring to as a testamentary. You can set up either charitable gift annuity or a charitable remainder trust, whatever you want, fund it with an IRA, and now you control it. That's either over their lifetime or for a specified number of years. It doesn't have to be 10 years. And now that creative child or adult doesn't have the opportunity to take out all that money at one time. It's going to be in time over time, and it's growing along the way. And now when they take the money out, it's phased out over a period of time.
And the charitable trust is like an IRA wrapper. There's no tax that has to be paid.
Right.
So you get the full amount of your IRA earning monies, not just a reduced amount after taxes.
So as an example, using this, I just said, all right, for arbitrary purposes, it's a $500,000 IRA. If this is done testamentary, you would get an estate tax deduction for that if it was your estate would, if you were needed. Creative child, we're going to say for the sake of discussion, is 45 years old now, gets nothing initially, but for the rest of their life, they get a 5% return on that $500,000. Initially, that would be a 500,000. Initially, it would be $25,000 a year, but over their estimated lifetime of a 45-year-old, they'd pull out $1.3 million. That's the estimate based on a 6% return and whatever else. So there are variables in there to look at, but that's what they're going to wind up taking out. Now that 25 will grow because if you're only taking out 5 and it's earning 6, over time it will grow. And so at the end of this, a charity would get $700,000 estimated by this, but they've taken out at that point $1.3 million.
Yeah.
Next to it over here is Ronald McDonald. What I've done on each of these slides is put one of the charities that support us just as a reminder, and I'll summarize those at the very end of this thing. But that's where it's very important to do this as a testamentary, because you don't have to worry about the RMD issue if that was there. You don't have to worry about the kid taking out the money and running with it because they can't, but they will get an income for the rest of their life or a set number of years that you decide, whichever way you want to set that up. And we'll talk more about uni trusts when we get farther into it. Here's the reason why some of this stuff really does matter. If you had, for the sake of discussion, a $2.5 million estate, $1.5 million in your IRA, and it's not unusual that the IRA you have is either the largest asset or second largest, depending on your home. So I'm going to say, for the sake of discussion here, your IRA is $1.5 million, arbitrary number. Your house is $1 million. The kids are going to say, we want the house. So we want the IRA because it's $1.5 million. It's more than the house. That's what we want, to give us the IRA. The problem is they'll pay out about 500 and something $1,000 in taxes for the feds, another roughly 200,000 for the state of California, which means they're getting net out of that 745,000. They looked at the $1.5 million and said, we want it. Reality says that's only going to get them a little under 750,000. And the charity, incidentally, is really happy because they got $1 million house, which they paid no capital gains on. Or you think it through and say, wait a minute, the IRA at $1.5 million goes to the charity, and they're real happy because they got more money. The $1 million house goes to the kids. And because of the step-up value at time of death, there's no income tax, there's no capital gains tax if they choose to sell the house. They'll get $1 million. That simply was changing which piece went where, but that's why the numbers are important, because
and the thing with this is that probably 95% of individuals do it the first way.
Right, absolutely, because my God, the kids are going to get $1.5 million. Of course they're going to do it. But you don't think about the tax that they're going to wind up paying. Yeah. And the fact that the house, because of step up, will get no capital gains tax if they chose to sell it or live in it. It doesn't matter, whichever way they want to go with it. Yeah. But that's why, yes, most of the people.
The other thing to think of is, look at the 745,000.
Yes.
Let's say the kids decide, I'm going to save this 745,000 and just live off the income off of that.
And
hypothetical.
Yes.
What if they were living off the income off that $1 million?
Right.
Because now that $1 million, if you just do it 10%, so I'm just, 10% return. Well, the difference would be 10% of 745 would be 7,000. Is that correct?
No, it'd be 74,000.
74,000.
Right.
$74,000 worth of income on the left. 10% on $1 million.
100,000.
100,000. Wow. I mean, that huge difference in income per year using a charity.
Right. And we'll see an example of that in a little bit on how that works through. So this is really important to the way people do this. Now, part of that, and again, we touched on it last week, but I want to touch on it again. Oh, bequest. I'm sorry. I was thinking of beneficiary statement when I saw the B. Make sure from a beneficiary standpoint, I'll repeat what we did last week. Make sure you keep a track of those things, who's where on them, and what's going on with it. I'm sorry, it is on the next slide. That's interesting. Those are out of order. I'm going to go forward one here. Beneficiary designations, I'll come back to the other one. Make sure when you go through on especially your IRA accounts or any of the other ones, that you have a beneficiary designation for those individuals. Don't say my estate, don't say some other things in it, but whoever that is, and you can have more than one beneficiary on an account, and you should have secondaries in case something happened to those people. But make sure that those are up to date in terms of what's there. A scary part of that is if there's been a change in your life, either somebody passed away or you got a divorce, if you don't change the beneficiary statement and you got divorced, your ex-spouse may get the money. We had that in our family with somebody that they forgot to remove somebody from an insurance policy beneficiary, and it was going to go back to the ex-wife. And that was not where he had wanted it to go, but it was where it was legally going to go. So keep track of those. Now, let me back up one because I want bequest. Bequests are when you give money after you pass away, either through a will or a trust or something else. It's the largest form of giving that there is, statistically, just in terms of sheer amount of money that passes through. It's paid to your estate before you calculate the tax. Again, today that may not be an issue to you, but it's automatically deducted. As I'd said before, if you give X amount of money away, that's automatically deducted. If you set up a charitable gift annuity, remainder trust, whatever it is, those items are in fact then deducted by the net value, what's left over afterwards. Outright gifts, we would highly recommend that you do a percentage, not a dollar amount. I use my sister as an example. She and her husband, who has since passed away, went through and said they want this much dollars to go to these nonprofits. My suggestion was change it because your estate is changing. If it went down for some reason, then the people you want to get the cash won't, and the charities will. If it goes up, why not share that with the charities in terms of what's happening and what's going on? So I'd recommend, if possible, a percentage. You don't get an income tax on a bequest, but you do in fact get an estate tax. So I'll jump through this guy. So let's talk about the first form of charitable giving other than the QCD, which should be an automatic. If you're 73 or older and you want to give to charity, please use a QCD. It's the best thing you can do for yourself. Charitable gift annuity. Charitable gift annuity, or CGA, is a nonprofit, whether it's a university, whether it's some other organization, will go through and say, this is what we want to be able to do. I want to give money to this nonprofit. And virtually all nonprofits will use the standard American Council on Gift Annuities, the rate that they have calculated and they use. You can think of this as a sort of a monopoly on nonprofits. The government decided to do this because they didn't want nonprofits competing with each other. I'll give you a little bit more money if you give it to me as opposed to the other guy. They didn't want them doing that. So they said, use a standard rate. Almost everyone except for a couple of well-endowed universities back east follow that rule and stay with whatever the council has done. They update these rates every year, every 2 years, something like that. They haven't this year. It's normally done, I think, July 1. So my guess is this rate will stay. It's based on your age, either a single life or a dual life. That's the calculation. The rate is locked when you sign up. So if I went in today, let's use as an example. I'm 80 years old. I always seem to go after 80-year-olds for some reason. I don't know why. I would get 7%. I would get 7% on that amount. If I put in 100,000, I'm going to get 7% on that. I will get that 7% for the rest of my life. It does not increase. It is not age. It is age adjusted when you start, not year over year, as it would with an RMD, for instance. That same 7% will be paid for the rest of your life. It is not going to be inflation protection because it's going to be up or down. It's not going to change. It's going to be 7% all the way through. It is irrevocable after you sign the form. However, as we have said at the financial, it's your money ones, a normal annuity contract is, I don't know, 8, 10, 15 pages long of form you can't read, where a CGA is generally a standard 2-page document. Whoever you're working with, whether it's Chapman University or a hospital or a community foundation, whatever it is, the person who is talking to you is not allowed by law to get any form of commission. This is not pressure sales. This is, if you'd like to do this, let's figure out how to make this work. There's no hurry. There's no anything else. So this isn't a salesman trying to sell you something. This is let me see how I can help you.
And the contract is 2 to 3 pages.
2 to 3 pages.
Understandable.
Right.
So this is not a commercial annuity.
Not at all.
Annuity
No.
just means stream of income.
Yep.
for life in a contract form.
Right. Whoever it is, be it a university, be it a community foundation, hospital, whatever it is, they have to set aside money into a reserve fund. It's managed by the commissioner of insurance. Certainly is in California, and I'm sure all other states it also is. They have to make sure and be registered with them to be able to do this, and have to prove to them we have set aside money.
Is there a downside to charitable gift annuity?
It's not inflation adjusted.
Exactly. It's not inflation adjusted, and it's irrevocable.
And it's irrevocable, those two. And otherwise, it's going to go for the rest of your life. They have to set aside the money for it. They have to protect it. I joked one time with Chapman University. So if something happens at the university, I actually get a classroom out of this if I do this. It's not it, but they set up aside money so that they can go through and do this. The other one, if it's a negative to you, and it depends on what you're doing, when you die, your heirs don't get the money. It goes to the charity. They're saying, we'll pay you, but we want the money at the end when you pass away. And that's what they do.
I've had individuals do charitable gift annuities to non-family members upon their death.
Yes.
The caregiver that was with them for 5 to 10 years, the gardener who's been with them, and those kinds of things. And you can do that for any amount, 10, 20,000. It doesn't cost you anything today, but upon your death, they would receive an income stream for the rest of their life. And then after their death, it goes to your favorite charity. And
if you're going through and saying, and rather than giving them the cash and saying, gee, if anything's left at the end, please give it to my charity, you're giving it to your charity. They don't control that. They can't change it. They can't say, well, instead of being here, I want it to be over there. No, because whoever started this holds the contract. And
you can control whether or not the income comes quarterly, monthly, or annually. I always say do it annually, unless it's a large amount, and do it around Christmas time. And they say, that's their Christmas gift going forward.
And you can defer the start date. It doesn't, if you're doing it for yourself during your lifetime, you can defer out the start date. And if, as Pete said, if you want to do this testamentary, I believe you still get the income tax deduction now. One of the things that we suggest is, one option in this is use a highly appreciated stock, which doesn't pay a dividend. Berkshire Hathaway. It's grown in value a lot over the years, but it doesn't pay a penny of income to you. So unless you sell it, you don't get anything out of this thing. But if you put it in here and have that in, you're now getting whatever 8%, 7% rather, if you're 80 years old. That's what's going to come back to you now.
Can you imagine if some
and no capital gains tax on that?
Can you imagine if some of the cryptocurrency owners at the time at the top of the market did a charitable gift annuity?
Yes.
I mean, turn that sucker into an income stream for life.
Right.
Let me emphasize again that run the numbers.
Right.
Again, do a gift illustration. This is a gift illustration on a charitable gift annuity.
Right. So in this case, for instance, we're saying, let arbitrary, 500,000 is going into it. That would give you today an income tax deduction of $220,000. That's almost half of it. And at this age, the age the person was 80 years old. That's what changes these numbers. Now, you can't change that 7%, because in this case, it's because they're 80 years old. That drives the 7%. But you're getting a $222,000 tax deduction now, which could save you perhaps $70,000. Now, you've got to have income to offset that. Remember, you're taking, if this was a appreciated asset, 30% against your adjusted gross income, as an example. When we put our office building into our charitable remainder trust that we did, we got a significant tax deduction for we just ended it last year. So in 2017, we did this, and last year was our first one. Each year, we got a 30% reduction in our income tax for 6 years using that money. This year we don't, but then again, the market's down, other things are different today. But that's what you wind up being able to go through and do. Another important part of this thing is over your lifetime, it's estimated you'd get back 400,000.
You missed the tax-free amount. Talk about that.
Well, it's going to come up right here because you're earning 7, but in actual fact, after tax, it's 11 because of this 35,000 you get, 29,000 of that's tax-free.
It's return of your own money.
Right. Therefore, almost 30. So therefore, that's what raises from earning 7 is what they're paying you, but after tax, it's 11.4%. Run the numbers and see that. In this case, what's your age? These are drop-in numbers. They're just real simple, and here's what you go through and look at. But that's where it's very important to know where are you going to earn 11.4% guaranteed for the rest of your life.
So if you're planning on giving to charity anyway, consider a charitable gift annuity, take the income tax deduction during your lifetime and get a greater amount of income. The calculations are normally that of the $500,000 that you give, that 50% of it goes to charity upon your death. That's statistically what they try to do,
right,
in running the numbers when
they do the calculation to come up with that 7%.
Yeah. Right. So, but that's information you don't really need.
And what they did find out, however, was, and to Pete's point early on in this session, what they discovered, especially with the charitable gift annuities, because it was very easy for them to track all these numbers, people lived longer.
Yeah.
This is all based on your life expectancy.
Yeah.
And here are the tables of debt. However, they discovered that when you gave money to charity, you lived longer, and then more money went out and that's delightful for you because you lived longer.
Yeah.
But on
universities have a lot of people over 100 receiving income from them. So, which is a great thing. So let's go to the next slide.
So as an example, you could fund this with with a QCD today. It's again up to 100% deductible, and that's what's available to you. The odd part in a QCD situation, and you can do up to $50,000 one time. Normally, with a gift annuity, you can only deduct the part that's net value, not what you're going to receive. With a QCD, it's 100% deductible because you wrote the check to the university or whoever it happens to be. Here it is. I'm doing a charitable gift annuity, and it never comes in as any other part of your income.
Yeah, it's deductible in this sense means it never has to be reported.
It's never
income.
Right. So that's what these guys go through. Where are we? So, and again, another sponsor just going through and looking at those. Let me get out of this guy. There you go. Okay. This is a different way of looking at it. Another opportunity. You can do a life estate versus a reverse mortgage. Reverse mortgages had a horrible reputation in the past. They're a little bit better now. They're sort of a last resort option, many financial people will say. You have the option, however, of also donating your home to charity. You continue to live in it. You continue to pay your maintenance, your insurance, and your taxes, but you're going to get a tax deduction today for the fact that when you pass away, that house is going to go to a charity. So it's important to recognize where these are. And again, you get a 30% appreciated asset against your adjusted gross income while you're alive, current year plus 5 years out. Maybe an outright gift, or it may fund an annuity. Funding an annuity, you will need a very large nonprofit to do it. That's a tough one to get. And a lot of large nonprofits, even like the American Heart Association, doesn't like doing these on homes. And you've got to be really careful with this. We raise it as a last resort for you in a sense, because you may need that house for other purposes later. So think really carefully in terms of how this is going to work for you if you're considering it. But it's one to look at. So here's an example. And again, just listing charities on the side of it. We had a house that's valued at $500,000. you set up a deed for a charity and this is going through, you're going to get a tax deduction out of that 500. You're going to get a $446,000 tax deduction because you really aren't getting much of a return other than you have, as it says down here, and your leftover interest in the lifetime living in the house is $53,000, is valued at $53,000. But the charity is going to get the house when you pass away. And this is certainly an option for you to think about. These are obviously, once you've set this up, they're irrevocable. You're not going to get it back. You can sell some of these and probably get something out of the $53,000. You could also go to them and say, hey, listen, charity, I want to clear this thing out. Let's figure out how we can work this out now, and basically work with them to make a sale on the house if you wanted to. So these are options for you to think about. Going through and doing it with the annuity, again, difficult to get, difficult to set up in terms of what's available, but they are options in terms of what's out there. I'm going to skip by them because they're tough to do. Peter, you looking at that question that's down there?
Yes.
Thank you. Okay. Okay, so we've talked through some of the simpler ways of looking at this thing. Now what I want to do is talk about a charitable remainder trust. I'm sorry. Yes, a charitable remainder trust versus a gift annuity. A gift annuity is very simple. As Pete said, 2, maybe 3 pages. Here are the rules. You're this age, you're going to get this percentage, and here's what's going to go on. They're going to protect you. They will not tell you that the income is guaranteed. They will tell you it is assured because we don't know what's going to happen. But on the other hand, I would suggest if you're doing a charitable gift annuity, do it with a large one, a university, community foundations, perhaps other things. There's some smaller organizations that try doing these, and I would tell you to be very careful with it, but they are a good way to make money. A charitable remainder trust is far more flexible, and here running the numbers is extremely important in terms of where that goes, because there are lots of options and lots of things to look at. They're also more expensive to do because you'll need an attorney to do these guys.
Run the numbers.
Run the numbers. So this is great when you have a highly appreciated asset. Just as an example, so big round numbers. We had an office building we had one over the time, 20 plus years. We had a very low basis because we did, as Pete mentioned earlier, a 1031 exchange along the way and got an even bigger building. And so our basis was tremendously small, first world problem. We had tremendous capital gains on this thing. And in looking at it, would it be better to sell it, pay the capital gains now, and invest the remainder? As Pete said a few minutes ago in another example, do you then produce the net amount? And we would have had a significant, easily 20-30% capital gains, because it was almost all gain from when we started. So in our case, we said, no, if we put it into the charitable trust, then the entire amount goes into the trust and is invested. And then we get a return from that, plus a significant tax deduction that we got. So if you put in an appreciated asset, you defer or can offset the capital gains. It's not that it goes away. When we get money each year, we get, it's called four-tier accounting for a trust, but part of that comes back as being capital gains income for us. So actually over our lifetime, we will pay that capital gains back. But we don't have to pay it at one time at the very beginning. It gets to be over the time. You can put in all or part of an asset.
I have a client today that she gives, she has a drug problem and tends to buy drugs throughout the year. And father knew this. And so he said, if we give her a lump sum, she's going to blow it. No pun intended.
Yeah, right.
Yeah. And so she gets approximately $40,000 a year. We put the portfolio together so that she gets capital gains income in that 40,000.
Lower tax rate.
Guess how much she has to pay in taxes per year? Absolutely zero. because an individual can have close to $85,000 worth of capital gain income and pay zero income taxes. So even in the charitable remainder trust, it's a deferral of tax, but usually the person is in a lower income tax bracket, and therefore it becomes really tax advantage to defer the capital gains tax and spread it over many years versus paying it in lump sum in the year that the asset is sold.
Right. So the issue when we talk about a remainder trust versus a lead trust, as an example, is who gets the money now. In a charitable remainder trust, you get the cash now, we get the money now out of our trust. And when we pass away, the remainder, charitable remainder trust, the remainder goes to charity. In a lead trust, which are not nearly as common, the charity gets the money now, and when you pass away, your beneficiaries get back your asset. But if you think this is going to really grow, if you were in Google before it went public and you had founder stock and you put it into a lead trust, you'd pay a charity for a while, and at the end you'd take it back out. But there probably wouldn't be any estate tax because it would have been at the original value. But you got to really have a large asset to do a lead trust. And remember, you have to pay the charity during your lifetime. So those are all issues that you have to consider. The other part of that is the cash is either a fixed percentage, which is a CRUT, charitable remainder uni trust, which is what ours is, or it's a fixed dollar amount, which is a CRAT, a charitable remainder annuity trust. The annuity trust can run out of money because if it isn't earning enough, it's going to eat through all the principal and run out of money. Charitable remainder uni trust doesn't ever run out of money, but it can get really small if you lived a tremendous period of time or we're taking way out too much money. You specify what charities get the money, and during your lifetime, or in our case, our joint lifetimes, we can change the charity anytime we want. In the times we've had the charity, the trust rather, we have changed the charity one time and reallocated who gets the money. And we can do that anytime we want because we created the trust, we control the trust. If you set this up, we've seen it where you're going to give the money to a university. The university says, we'll manage it for you, no problem. Okay. In some cases, then they will lock in, we're the only ones that get the money. So then you cannot change it. It depends on how that trust is written. We said, we'll manage it, we'll administer it, deal with it, but we can change our charities. What we did when we set ours up was we specified these charities will get this percentage, and the total of that was 50%. Then we said the remaining 50% will go into a donor advised fund, and our daughters will oversee that. They don't get the money. They get to decide what charities get the money. And that was a legacy thing that we wanted to do, was to allow them to have the option of, this is how that money is going to be spent, contributed out to society after we pass away, a legacy. And we can change all of that. If we decide we don't like our kids, we can give it all to charity or the other way around.
But they've become so charitable and it's just amazing. Isn't it fun to see them being involved?
They are very driven by nonprofits and have a lot of time invest a lot of time and money into it. With the donor advised fund, I had decided I wanted to open the account before we died, which we weren't planning on doing soon anyway. Because otherwise, when you die, the estate can't give the money to a donor advised fund that doesn't exist. So we opened it at Schwab, it's a low amount, whatever. So we opened it with $2,500 or something like that. And when we were discussing with our kids, they said, well, can we pay the $2,500 for you? Okay, why? Because can we use it? So they have over the last few years, if at the end of the year, the company that they're running, they own, if they want to distribute money to charities, they don't have to try to figure out in late December who should get the money. They put the money into the donor advised fund. So they're using it today as a place to hold money and then pay it back out to charity over the next year or whenever they want to. So they're making use of it today as a tool for themselves, and then we'll have the remainder of the trust when we pass away. A charitable remainder trust, for instance, can exist either for a period of time, 15 years, for instance, or for a lifetime, or for a lifetime plus years. And I'll show you examples of all of those in a few minutes. But again, these are things where it requires thought and it requires a process in terms of what's going on and how you look at these things. So let's look at an example. If, for instance, I had a piece of property at $500,000, so I'm going to put that money in. I put ages up here on this just for the sake of the discussion, and I said they're going to take out 7.5%. That number isn't locked in because of their age. This number can be anything you want. The lowest number you can take out is 5, and you can take out as much as you want as long as it fits the rules. And that's where running the numbers become important. And that's what I'll show you in just a couple minutes. So in this case, if they had put in 500,000 into this with 7% at this age, they'd get a $230,000 tax deduction, which potentially with income tax would save $73,000 today or over the next couple of years. You bypassed the $440,000 capital gains, which means you aren't paying out $100,000 in capital gains today. Otherwise, when you sold this, you'd have to pay out $100,000. You'd wind up net with $400,000, not the $500,000 invested. The estimate is that over the 15 years, I'm saying they're roughly 80 something years old. So they're saying estimated life is about 15 years. They take out more than they put in. And it's 7.5% because, as Pete had noted earlier, a portion of this is tax exempt. They'd be earning 8.5%. Let me back you up. I wanted to say one more thing over here. All of this is, you set what the numbers are, what you think it's going to earn. You set what this percentage is, and it comes through and says, this is what the result of that is.
Yeah.
And it is or is not allowed.
Yeah. Charitable remainder trust is very, very flexible. And so it becomes even more important to run the numbers and also to discuss what's your objective here. Right. Are you trying to avoid the capital gains tax? Is that the main primary purpose? Do you just want to avoid all taxes and get cash out of the sale? You just don't want to pay any more taxes. Or you go, hey, I got a piece of property and I'm tired of tenants and toilets, but I want to retain the income that I was getting from the rental. You know,
so doing that one, if you do this one, you're saying I'm going to sell it out. A very important part in this is, if you want to do this with a piece of property, first you set up the trust, then you put the property into the trust, then you sign your agreement to sell the property. We almost screwed that up. If Pete and I had waited a couple more weeks to take our drive, it wouldn't have worked out because we were about to sign a contract with a realtor. If we had, we couldn't put it in here. So you need to set up the trust, fund it with this. So in our case, our office building was held in our living trust, our normal trust that we had. And we then did a transfer from our personal trust into our charitable remainder trust, and then signed an agreement with the realtor. We'd been talking to the realtor. He had buyers for the house, but we couldn't sign anything that said, yes, go ahead.
Yeah. And the same thing with if you want cash out of the deal. We had a couple that wanted to travel around the world. And so upon the sale of the property, they wanted cash to do that.
Right.
And so we took the property and said 20% to Mary and Joe and 80% to the charitable trust. That's right. How the title was written before we send it to the real estate agent to do a contract or put it into escrow and to sell the property.
So running the numbers, in this case, for the sake of it, I'm saying it's $1 million piece of property. here's what your gain is. The system will say, if you said to me, I want this, but I want to know how much money I can take out. Pete just said 20%. So in this case, I put in the numbers and said, I want to take out the maximum amount. I'm going to have to pay some capital gain, but I'm going to get a tax deduction. I want those two to equal each other, so I net zero tax in this. In this case, putting in $1 million, they could take out almost 30%. The rest of it goes into a trust, and we played with the numbers and said 6% is a good number for them. So in this case, cash out. And Pete was very good about this when we first started talking about the office building. You don't have to put it all in. You can set fractions, whatever you want to do with it. In this example, they would get a tax deduction of this much, capital gains of this much, and they're offset zero. I will tell you, the tax deduction might not be able to be taken in 1 year. It may be so big that it would require a couple of years to take. So the timing may not be perfect on this, but in this case, they could have taken out, this example, almost $300,000, almost 30%, and had a zero tax effective rate when you came out of this thing. The rest of it then goes into the trust.
Yeah. And people don't tell you before you sell the property, any kind of capital gain asset, to run the numbers,
Right.
Because it requires a lot of work. One, two, it requires having the software to do it. And three is if their real estate agent is ready to make the commission, they don't care about the tax consequences. And usually people don't really understand the tax consequences until the following year when they're actually sitting down with their CPA, and then it's too late to do anything.
Right.
You know, it's run the numbers before you sell a capital gain asset.
We've been talking to a real estate agent who was a senior agent. He'd been selling buildings like ours for years, was very well recognized for what he did. And when I told him what we were doing, he was dumbfounded that this could be done, because he kept arguing, no, keep the building. It's going to appreciate an asset as an asset, and you're going to have more money later on. And I said, tenants and toilets. I was the only, we occupied the building entirely ourselves. I did not want any other tenants. I didn't like me as a tenant. And the whole thing of maintenance and the tenants and toilets thing is critical. Every time it rained, the damn building leaked, and it really made me mad. And I was like, I don't want to be near this thing.
Well,
Besides that, you can't guarantee me this amount of money year over year, because it's going to depend on the building. And so I said, no, and he had never heard of the option of doing this, and yet had been doing this for years.
Yeah, one of the things that they have heard about, it's called a tenants in common. It's called a TIC, and even in that scenario, you're still in real estate, but it defers it out before you get your income back 5 to 6 years.
Right.
The money you earn is for you to use in your lifetime, whether it's to give to your kids, whether for you to spend it, or whether it's for you to give to charity. I haven't seen, I've been to a few cemeteries. I don't see on the gravestone your net worth when you die.
Good point. Good point. So here's an example where you can take the money out. It is not put all of it in. It's not all or nothing. It is, you can split it, and the system will very easily give us back that information. You could say, no, set it at 20%. Okay, then it'll tell you what your deduction is and everything else about it. All of that's available because you're running the numbers. So here's an example of one, and I'm looking over here to see where we're going to go from this one. So here's an example of I want to do this for my life and then a number of years. I like to say, Pete did this a while back. In fact, last century, Pete did this with a client, and they went through and said, here's what we're going to set up. And during their lifetime, they got the money. And then was it 15 years, I think, afterwards for that trust?
Yeah, he wanted to, he had Edison stock, and he wanted to benefit his nieces and nephews. and his motivation, charitable motivation, was the environment. The Redwoods, Laguna Canyon Foundation. He wanted
an Indian
legacy,
a Native American school in Montana.
yeah,
That's another one.
yeah,
Yes.
yeah. And so and the Edison stock, he worked for him for 40 to 50 years, literally a zero basis asset. And if he
Right.
knew if he sold it, he was $250,000 would go into taxes.
Right.
So
Yeah.
this is what he did.
Right. So here's an example where not only is it for the time, that's the immediate tax deduction that's coming out. So it's life plus 10, 5% out. The charity is going to grow because we were saying it's earning 6%, and therefore taking out 5 is going to make it grow. So they're estimating certainly $705,000 coming out. And again, it is income plus 10 years for whoever that beneficiary you want to give the money to. And it's a very effective way of going through and doing it. Then at the end of that time, it goes to charity, because we were involved with the nonprofit who was managing the account. And at the end of it, they were one of the beneficiaries that came out of it. Now, let me do something else with this. So I'm running this at the moment. You can see that this is at 5%. Is that the most they can take? No. I went through and ran exactly the same thing at 7.5%. It's still the same dollar amount. It's still the same 10 years. But the difference is at 7.5%, you get less of a tax deduction because you're taking more money now. But it really is almost the same amount. Do you want to take out more now and less later? So what's the net present value? That's the difference between this. Taking out at 7.5% will cause it to be less later on, but you're taking more today. We looked at it in our case and said, we're going to take out a higher percentage now because we're at a younger age and we want to travel more, we want to do other things. When we get older, or as old as we are now at times, we're going to be using less money because we won't be traveling as much.
Okay.
So that was but it's running the numbers. And even when you do the numbers in running the software, you can pick 2 different rates. I mean, we could have said 5 and 7.5 in one run, and it'll give you both of them as examples.
The other thing too is that what, universities all have, and most of your major hospitals have what's called plan giving specialists.
Right.
And these folks also have the software and will work with your professionals. Just understand that they're also paid by the university or by the hospital. So they're going to hopefully encourage you to name them as far as the remainder charity.
Right.
You don't even have to name a charity in a charitable remainder trust. You could say, I will name them whoever I want later on in a separate document. So, there's an immense amount of flexibility here. And you can name your own donor advised fund as the remainder charity. Right. And have your children be the advisors on that fund as well. You can get really creative with these kinds of programs. And again, don't forget, you're losing some control over that money. However, you do feel good about doing it because it's going to a passion, hopefully, that you have.
Right. And the important part, we keep saying it over and over, run the numbers, because, and I will tell you that, Chapman University, who's been a sponsor of the seminars for a long time, they ran the numbers for me when Pete first suggested it, and they'd be happy to. And
never was an obligation.
Chapman is not receiving any money from us, and they'll tell you, we're not asking you to do that, but they will give you the numbers as an initial. And then I went through and said, I need more. It didn't make sense to be digging in on them. And so that's when I licensed Crescendo and said, I'll do these and run my own numbers, and then continue to do it today for other people.
Yeah. So. The hope is that it becomes a good cocktail conversation. Spread the word that these things are available, because professionals don't earn much income from these.
No, because they're not making. In fact, it's interesting. Even talk to a couple of investment companies. They're not sure they want to do this because the money may be moved somewhere else. If you do a charitable gift annuity, they really don't want to tell their clients about that because they're not managing the money anymore. They may, in terms of investing the money from this, but it depends. They may actually be harmed in a sense by doing it, and that is not constructive for them.
So we appreciate you listening.
And we'll keep talking. So the other part, and it goes to Pete's comment a moment ago of the flexibility of a remainder trust. You can do a standard trust. If I had my Berkshire Hathaway stock, which I don't have any, but if I had a bunch of that, I could put it into the charitable remainder trust and take immediate income from that because it would be sold. And now the cash is there and invested in something that would pay a dividend or a return. And now you're getting the money out. As soon as it's sold, you start getting your income back from it. You could do a thing called the NICRUD, net income only, where I really don't want much money now. This is a planning tool. If I was 55 instead of 73, I might say, I don't want much now, but I want it to grow and be available to me later on. So I could say, Pete made a comment a moment ago, you lose some control. On the other hand, we control how the money's invested. We have an investment advisor and we direct them. If I wanted to, I could say, I only want to have income, so give me dividend stocks only. And that's what I want to invest in, and I would get that income. Or as Pete said, you can set it up where I only want things that are going to offset my capital gains income. So you can control that and change how this trust is going to go. A NIMCRUD is, that was all really great, but now that I retire, I want a lot of money. So therefore, I want to make up all the money that was lost over those years, because it wasn't invested in a way that it would grow more. So then you can specify that when you write the trust, that it is a net income with makeup, NIM trust, that says, give me the rest of that money back again. That's an option. In our case, ours was a flip. So we knew that when we put the building in, until it sold, it wasn't going to pay as much money as we wanted. We got the income that it earned during the time, because when we put it in 2017, it didn't sell until 18. So we didn't get the full income amount until it flipped. And then the following year, we started taking out the percentage that we get. So I'm one of those odd options. Pete laughs at me because I'm one of those odd people who normally when I'm having lunch, I watch CNBC and look at what the stock market's doing. Most people choke at that or cheer or whatever they're doing. I just look at it as interest, because what I care about is, what does this trust equal on December 31 of each year? And then I know my income for the next year is going to be X percentage of that amount. So a flip allows you to say, until either a certain date or event occurs, or an event like selling the building, or a particular date. So I can defer out the start of this for X number of years. But a key part of this on the other side is you get an income tax deduction now, even though you're deferring this off. Let me give you a different example of something. And this sort of goes back to a thing Pete was talking about. Here's an example of what if and we look at it. What if I sell it and gave the money to charity? So in this case, arbitrary number. The house is $1 million. My basis is $100,000. My gain is $900,000. Forget all the exclusions and other things. For the sake of the numbers, I could say it's a 40% tax. That seems high, but if I take the federal rate and the California state tax, and then there's also like a 3.8% add-on in here somewhere, I'm going to say round numbers, it's 40%. I'm going to pay tax of $360,000 on that million, which means I'm going to net after tax $640,000.
By the way, no matter what you do when you sell a capital gains tax asset, that's what you want to know. What is your net after tax?
Right.
That's the number.
It's not this number. No. It's that number that counts to me.
Nobody should. And by the way, hardly anyone tells you that beforehand.
Right.
But that's the number you need to know.
Right. Yeah. So, but that means then if I said I'm going to give that now to charity, I'm going to do a CGA, charitable gift annuity, and I put in $640,000 at a 35% tax rate, I'm going to have a savings of $78,000. That's very nice. Now, remember, I had to pay $360,000 up here, but I'm going to get a tax deduction of $78,000. 80 years old, I'm sorry, I get a 7% gift annuity, which means I'm going to have $44,800 for the rest of my life. That's nice. However, if instead I gave the house directly to charity, $1 million, they pay no tax. There's no capital gains because they now own it. I'm going to get a tax deduction of $350,000 at my 35% rate. That means I'm going to get a $122,000 deduction, which is $44,000 more of a tax deduction because I gave the building to the charity. The charity then sells it on their side. No capital gains paid by me. If I take my $1 million and I 7%, I'm going to get $70,000 a year. Same stinking building, which means I get $25,200 every year for the rest of my life, simply because I gave it to charity rather than selling it and then giving the remainder to charity. Remember when I talked about the QCD, the money you give versus what is net after? And as Pete has said several times, it isn't what you sell it for, it's what you get when you're done with it. Basically, it's the net. That's the important part. I did this, and you had this example one time in one of the sessions I was doing a live session. And there was a lady in the back of the room that screamed at me when I put this up and just going, I just sold a building and gave it to charity, the remainder to charity. Why didn't I do this? I don't know. You lost $25,000 a year for the rest of your life because of the way in which you sold it. And incidentally, the charity's really happy because they got $1 million. So they got more money than they would have over here because they would have only gotten $640. So they got $360,000 more. They don't pay capital gains. So that's the important part of run the numbers, Pete. Yes.
Yeah. And the thing of it is that the government encourages you to do this because if you send your tax dollars to the federal government, then the federal government pays for social services. It's pennies on the dollar.
Right.
This way, what they're encouraging you is to spend it on social services, and you get to direct where you want your tax dollars to be spent.
Because sometimes our politicians don't do what we would like. They do other things. And sometimes
this way
they can't agree on what they're doing anyway. So
you control where your tax dollars are going.
So we've talked about a donor advised fund. In a way, it's having your own private foundation, except there isn't all the cost and overhead and rules and restrictions and everything else. You can put the money into it. You decide when you want to take it out or what you want to do. You can set it up through, for instance, a community foundation, Orange County Community Foundation, brokerage firms. As I say, we set up ours at Schwab, and it was, I think we put in $2,500. I don't know if that was the minimum. I think it may have been less than that, but we chose to open it with $2,500. So relatively low amount to open them. It's a low fee. They talk, because of the way standard deductions versus itemized deductions are today, sometimes charities will say, well, if you bundle your charitable gift together, you may get a higher deduction. So rather than giving that bundle to the charity and wondering what they're going to do with it today, you put it into a donor advised fund, which is fully deductible as if it went to a charity, because it is a charity by itself. And then you can allocate that money out, such as what our daughters were doing with it. You advise when and where, how you want to give the money out to charity.
And it could go to anywhere in the world, by the way.
Anywhere in the world, as long as it's, in US, it's a 501c3, whatever.
And it has to be a qualified charity in the country that you're going to.
And the key to that is this is a donor advised fund. I no longer own the money. It's now in an advised fund. I can say, this is what I want. However, they're going to go through and verify that this is a valid charity. So if you're giving it to, we gave some money a while back to a foreign charity. They happen to have a US arm, so we gave it to the US side. they validate that is a valid charity. It isn't, do they like it? It's, is it valid? So I don't need to worry about that from my standpoint in terms of what's going on. Currently, you cannot use a QCD for this. You've designated, in our case, we've said when we pass away, we'll have the children do it. And that's exactly what we chose to do. Bringing it all together and sort of bringing this all to a conclusion here.
Perfect timing, Don.
Don't you like that? Isn't that an interesting thing? Go through and see if you want to do charitable giving. You may not want to, and that's perfectly fine. There's nothing wrong with it.
Yeah.
If you want to set up a legacy or something else, you have a range of options. Make sure you have a plan for what you're doing and what's going on, and then decide. And we suggest that you talk to your family about it. They may hate you later if you don't tell them. We chose to tell our kids in terms of what was going on, and talk to the charities too. If you have no idea who else to give to, these are the charities that sponsor the seminars that you're watching. So these are the ones we've sort of put them along the edges, and just at the end of this, just say, hey, these are the folks who do in fact support financial and estate literacy, being a 501c3, to be able to put these on for you so that you don't have to pay anything for it. That's who I am. It was interesting when I first did this with Chapman University, they had this page that was sort of their disclaimer that said, we're not lawyers, we're not okay, that's what we do. Pete doesn't like the picture of me anyway, so we'll stop sharing this. But let's come out of here. So Pete, that's pretty good timing, isn't it?
Yeah,
oh, shoot, man, I got a minute to go. I could have talked longer. Okay, so what I'm going to do is to say thank you very much for everybody for being here. This has obviously been financial estate literacy. We've been doing charitable giving, charitable opportunities. Hopefully you're interested. If you have any questions or thoughts in terms of, what's going on, or how can we run the numbers or something else, there's get a hold of us in terms of running it. And I'd be happy to run numbers for you. We're doing it for a number of people right now. And happy to just talk them through it.
There's a question, which is a good one, and that is, can a charitable cause be added to a revocable existing living trust to accomplish the goals of a standalone charitable trust? And the answer to that is that, first of all, you can add a charitable organization to your trust at any time as an amendment. Okay,
basically, it's a
yeah, and it doesn't. It doesn't, yeah, exactly. And the money doesn't go to the charity until after you're dead.
Right, yes.
Okay, so if it doesn't work the same way as a standalone trust, because in a standalone trust, you actually have given monies away irrevocably to your own charitable trust that is no longer part of your estate.
Correct.
So if you're trying to say, does it accomplish it? Money's going to the charity? Yes. Does it give you an income tax deduction, etc.? No. So
it might give you an estate tax one. I mean, in the case, for instance, of my sister, in her revocable trust, she has, on my death, give X% to this charity and to this charity, and tell them it's for this reason, because that's one of the things we wanted. So easily it reduces the amount her estate is and will be paid out when she passes away, but she doesn't get an income tax deduction. I've tried to convince her to give the money now so it gets a tax deduction, but and because that I'm going to administer her estate if she goes before me, but so all the pieces.
Yeah, people, I mean, giving money away and I get income, it just doesn't.
It seems wrong.
Yeah, capiche. It doesn't make sense, you know.
Yes.
Let's see.
So, do you have more to this one, or do you want to go to the hands up?
No, let's go to open it up if anybody wants to ask.
Then what I'm going to do at this point is, again, thank you very much. Next week we will be talking about estate administration. If you think this one was lively, Pete and Trevor next week are just going to be unreal going through those. And so I'm going to thank you very much, and I'm going to stop the recording at this point.